Hello everybody, this is Patrick MontesDeOca with the Seeking Alpha report published May 31st, 2018. Philadelphia Gold and Silver Index sees bullish breakout. Summary: breaking above 85.97 would continue to validate the acceleration process taking place toward the target zone of 92 for the Philadelphia Index. Last week, the gold market closing at 1291. It opened at 1290 and came down last week to make a low of 1281.20, almost activating the 1280 buy levels. A rising CRB index and rising interest rates, which could significantly impact sovereign debt payments, should be good for gold and silver. The US dollar major top. The US dollar has extended its rally to a potential peak that could be completed by the end of this month. This period fulfills a 2-month target that was anticipated in our earlier reports. This would also complete the 3-week cycle that projected the early May high. If you look at the dollar, it has declined from November-February period, and it has recovered most of that decline. The major resistance, the monthly resistance, is at 94.50 to 95 basis levels for the June dollar index. As we come into next week, the US dollar is potentially getting ready to put in a major top. But to get the price confirmation, we need a close below 93.50 to confirm the basis, the June contract. Gold and silver cycles rebounding. The gold and silver markets have rebounded after testing the extreme below the mean levels that we published in our trading report on May 18th, 2018. We recommend that if the market comes down to that B1 level of 1276 and 1280 in gold, to cover any short positions and reverse and go long, using the 1280 as your stop level. This was the 5-week low that we track in terms of identifying the cycle development for the gold and silver markets. For the next 30-day cycle, it would take a new daily close about 1307 to give us a more solid confirmation that a multi-week low has taken place. Overall, for next week, we see the market continuing to rally into the anticipated target on about June 15th, plus or minus a week. This identifies for us the weekly cycle development that is taking place, and what we want to see to identify the acceleration is the VCPMI average price as we come into next week, which gives us a measurement of when the reversion to the mean could unfold. As we come into next week, the cyclical energy of the market is beginning to indicate that the resistance levels are in the area of 1314 to 1338. If we use the weekly numbers, if we get a quick rally as we come into next week, we recommend you to lighten up and take some profits at these levels. This price action, if it occurs next week, could support some additional buying into the early June. The acceleration phase would be validated if we were to get a close on gold above the 1325 to 1328. This is where the VCPMI has been able to identify where the new supplies would come into the market. Federal Reserve officials, including Jerome H. Powell, the chair, have noted some potential risks to growth, and this makes it possible but unlikely that the Fed will reflect more of those inflationary concerns in future statements. If we look at the last meeting, the Fed held interest rates steady at the conclusion of its 2-day policy meeting. It acknowledged rising inflation, but there is little indication that the officials are concerned about the inflation or a sudden slowdown in the economic growth that would hasten interest increases. As I have argued, I find it difficult to see how increasing interest rates could help economic growth. The inflation factors that have unfolded seem to lower expectations that inflation will increase, and there is no reason based on government data points to increase interest rates. We do not have runaway inflation. I continue to feel that with the pressure of rising interest rates, we are beginning to see throughout the world economy pressures developing, such as in the Eurozone, especially in Italy, with rates potentially accelerating to uncontrollable levels, very much as we had back in Cyprus and Greece just after the 2008 recession. The Fed has been able to control the interest rates and provide a tremendous amount of cheap money, primarily for Fortune 500 companies who were able to borrow at record levels, low interest rates, and a lot easier than the mainstream firms, and use that money to buy their own stocks, adding fuel to the stock market fire that we seem to be experiencing. The stock market seems to be anticipating that interest rates won't or can't continue to go up. Rising interest rates crippling the U.S. economy. I am uncertain when we will reach the plateau of where and how high interest rates can go before we start to see fractures and wider divergences in the economy. At such a point, I believe the Fed would be forced to reverse this interest rate strategy and potentially begin to lower interest rates. I feel that if you look at the world economy, I don't feel there's any justification for this policy of raising interest rates. Raising interest rates could devastate the world economy, starting with the U.S. economy. We are looking at U.S. debt in excess of $21 trillion. A 1% increase in rates would put serious pressure on the U.S. fiscal budget. Even if interest rates return to an average or mean of about 4 or 5%, payments on sovereign debt would exceed many governments' ability to pay, which will affect the overall bubble of the economy that has been built based on the policies of falling interest rates. Rising interest rates help the dollar. The 10-year bond is trading right around 3%, and an increase about 3% would be highly inflationary. Rising U.S. interest rates have been the fuel that has driven the U.S. dollar rally. We have to look at what the gold market is discounting. Trading in the 1300s now, showing tremendous support under 1300, and we are beginning to see a different complexion in the structure of the U.S. dollar. Commodity Research Bureau Index long-term move up. One of the areas of concern that seem to be indicating a shift in the energy sector is the fact that we see crude oil trading at its highest point since May 2015. Although we are short-term overbought in crude oil, it has broken the downtrend. When you compare it to the S&P 500 as a whole, that downtrend has taken place since 2014. This leads us to believe that the CRB index has broken through important resistance levels and that potentially a long-term move is unfolding. This might be one of the factors supporting the silver and gold market. If in fact we were to go into an inflationary period, which seems to be indicated by the breakout that is taking place on the CRB index, we could see interest rates in gold move up sharply. The gold and silver market have remained more or less range-bound for a few years, but we're looking at the possibility that this may be shifting, particularly if you look at the gold and silver ratio, which is down at about 80 point levels, indicating that silver has started to outperform gold. This is another indicator that we have that we might be looking for a long-term bottoming formation for the gold, and especially for silver. Based on the gold and silver ratio, the silver market is becoming potentially a very active market, which could gain in appreciation substantially against the price of gold. Next week, we'll look at the silver in our report, but I want to look at the report we published on May 14th and review what took place last week and what we can expect as we come into next week based on our May 25th report. One way to follow gold and silver is via the Philadelphia Gold and Silver Index. Since the start of the year, based on the weekly chart, the high was made on January 24th at about 92.08. Since the index has declined pretty much on an equal basis to the rally from December 7th. But coming down to a low of 76.39 on February 9th, the market completed the secondary bottom that we have seen. Is the market continuing to revert to the upside, making higher lows as we have built what appears to be a major consolidation since the bottom was made on February the 9th. If we incorporate some Gann trend lines, we can see that the market has broken out of this trend. The resistance as of May 23rd, the signal came in on the 24th on the close at 84.38, and we expect that a little filling might take place, possibly testing this breakout point of 83.21. And upon testing this, if the market is inclined, the target that has been activated is all the way up to 91 or 92.04. These trend lines indicate the uptrend, downtrend, either the minor or the main trend. For a market whose trend is up, we use a green trend line, and an uptrend is declined as a higher tops and a higher bottom. The target zone, if we incorporate the Fibonacci retracement, is 89.42, which equals a 78.6% Fibonacci retracement all the way up to 92 area, which is the top of the end up of the uptrend line resistance that started back on March 26, 2018. In technical analysis, a Fibonacci retracement is created by taking two extreme points, usually a major peak and throw. On a stock chart and dividend, the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%, April 12, 2008. By connecting the highs of April 18, 2018, we can calculate and identify the target zone of this breakout that appears to be taking place, which is in the same area that we apply Gann trend lines and Fibonacci retracements. This confirms as we come into next week's into the next few weeks that the market, regardless of any short-term corrections, is recommending that we buy into this correction as a result of this major consolidation phase or bottom that we have been building since February. Breaking above 85.97 would continue to validate the acceleration process taking place toward the target zone of 92 for the Philadelphia index. Last week's VC PMI gold report. The structure that we have published on May 18th for the gold last week. Let's see what the trading instructions told us as we came into this week, ending May 25th. Last Friday, the price of gold closed at $12.91, and the report indicated that based on the first filter that we used, the 18 weekly moving average of 1328, the market was bearish. And the VC PMI is also able to tell you that if the price closes above that filter, that it would negate the previous trend momentum. In this case, the bearish trend would be negated to neutral. So you can use this filter as your first indicator of the changes that take place in the trend momentum from neutral to bullish or neutral to bearish. The second filter that the VC PMI uses is the price momentum indicator with the market closing below the weekly price momentum indicator of 12.99, it told us that the market is bearish. When it identifies the market being bearish, it activates where to cover these positions, which is at the B1 and B2 levels below the mean. But the VCPMI also tells you that if the price closes above 12.99, it would negate this bearish price momentum to neutral. And you can use this as a stop level as well. One of the things that we teach our subscribers at the Equity Management Academy is the methodology to identify the trigger points of the reversion to the mean, of the extreme relative implied volatility. It is done in real time, in a live trading room. It is very difficult to, once we publish a report on Seeking Alpha, to adjust to the changes that the market can have made. For example, the price closing at 12.91 coming into this week is bearish. But it also told you that if it closed above 12.99, this bearishness would become neutral, and a second close above it would activate a bullish uptrend. It would also identify the target zone and the extreme above the average price of the mean. Coming into this week, I told you that sell one level of 13.14 or two of 13.48 could be activated when a close above 12.99 takes place. The VCPMI accuracy, what did gold do last week? The low last week was 12.81. The high was 13.07, closing at 13.0370. What happened here is that with the market closing at 12.91, it opened at 12.90 and came down last week to make a low of 12.8120, almost activating the 12.80 level. 12.76 to 12.80 were the levels indicated to cover your short positions. The market came back up, and if you did not get activated because you waited until the market touched it, you had another opportunity to validate and confirm the reversion to the mean when the market crossed back up above 12.99. It would neutralize this bearishness, and a close above it would activate a bullish signal, which it did by the market making a high of 13.07. You have to be aware of how the price action trades once it trades through the price and the energy or direction changes. You need to understand what the AI algorithm is trying to tell you, what the artificial intelligence of the algorithm is trying to tell you. Let's take a look at the supply and demand factors coming into next week here, the report that we published May 25th, 2018. Clearly indicates that with the marketing closing at 13.04, which is below the 9-day weekly moving average of 13.23, is confirmation that the weekly trend momentum is bearish. If the price closes above 13.23, it would negate this bearishness trend momentum to neutral. A second close above 13.23 would activate the weekly trend momentum to bullish. If we look at the weekly price momentum indicator for the coming week, it gives us the average price momentum for the coming week. With the market closing above it, which is above 12.97, it is confirmation that the price momentum is bullish coming into next week. It also tells you to use this level as a protective stop to manage risk. If we close below it, you have the option to go neutral. A second filter that we use to identify the leverage price, the average price or pivot point. Once we have these averages, average prices, average price levels, then we can anticipate that as we come into next week, the sell 1 level of 13.13, the first target, the sell 2 level of 13.23 is your second target. If you're coming in long, where you can, here's where you can unload and take some profits on your long positions. The Alternate is that the price comes down below 1297. It activates the B1 level of 1288 or the B2 level of 1272. One of the questions that I have been asked is how I am able to calculate the 95% probability of time we expect the price to revert. The algorithm, when the price reaches the extreme above or below the mean, it identifies a probability factor. If the price reaches the sell 1 level, there is a 90% probability mathematically that the price will revert back to 1297. If it does not revert, then it could reach the sell 2 level, which is a 95% probability that the price will revert back to the average or the mean, which is 1297. If the price closes above 1323, the VCPMI tells you that the resistance level of 1323 has now become support for the next higher price fractal, and this is where the shift occurs in the VCPMI. It tells you that if the price closes about 1323, you can expect higher prices to come. This is the acceleration point, a breakout. This is the highest resistance level of the highest extreme volatility above the mean. And if these are the entry and exit points we use to enter and exit for day and swing trading positions. Using the VCPMI automated algorithm allows a trader to have a systematic structure for the day, swing, or position trading. It analyzes the relative extreme implied volatility of that time frame. For day traders, the VCPMI analyzes a structure of 5 levels of supply and demand. It identifies the average price for the following trading session. Once we're able to identify the average price or the mean or equilibrium, the price for that trading session, then we can extrapolate the extreme of the relative implied volatility of where it meets our criteria for optimization. In this case, the VCPMI uses 5 levels. Why 5 levels? Because it is a perfect Fibonacci number. The number 5 is a perfect prime number. In the mathematical structure that we use, it is a major component in creating the structure for the artificial intelligence that goes into the algorithm. The artificial intelligence is used to automate the algorithm. We can see that the basis of the structure of 5 level relies on Fibonacci numbers. Using the Gann calculations to identify the supply and demand levels for the preceding day by using the previous day's criteria, we can see where the supply and demand resistance levels can be identified. The VCPMI artificial intelligence uses colors in charts to identify where the supply and demand levels so that they can be clearly shown. Within these levels, we can begin to see the structure of identifying the highest relative levels of the implied volatility of the extreme above and below. The mean, for example, the artificial intelligence system provides the sell 1, sell 2, or sell 2 level of the price range of the potential supply that it has identified. It instructs you that when the price is identified in red, it automatically means supply. The price levels of S1, S2 give you the price levels where the potential supply can be traded. The actual energy of the market, where buyers move and price into the sell 1 levels depending on how much demand or buying power it is able to absorb the selling pressure or supply identified by the sell 1. The price will react based on the basic supply and demand law of economics. If there is more demand than supply energy, the price will rise and it will close above the sell 1 level. It tells you that at that point, the demand is greater than the supply, and it will potentially test that range between the supply, between the S1 and S2 levels. And the market may reach the sell 2 level of supply. In a mathematical sense, the sell 1 level represents one-on-one a relative implied volatility of the extreme above the mean. The sell 2 level is a 2-to-1 factor of the relative implied volatility of the extreme above the mean. The probability factor of sell 1 and sell 2 is between 90 and 95% probable that if the price reaches the sell 1, it is a 90% probable that the price will revert back to the mean from last week. When the price activates the sell 2 level by touching the sell 2 level, there is a 95% probability that the price will revert back to sell 1. And if it closes below sell 1, then there is a high probability that the price will revert back to the mean when closes above it, below it from sell 1. When the price reaches the mean, it could revert back to B1 or the extreme below the mean of B2. If the price reaches the B1 level, there is a 90% chance that the price will revert back to the mean or that the price activates the B2 level. There is a 95% chance that the price will revert back to the B1 level or the mean average or equilibrium price that has been identified for that trading session. When you look at the VCPMI structure of 5 levels, the average price and 2 levels above and below the mean, which are the levels of extreme volatility for the trading session, the algorithm identifies the sell 1 and sell 2 levels so that the price reaches these levels. The algorithm goes back to a neutral position, and you allow the algorithm to identify for you the trigger points for the next movement of the market. The VCPMI adjusts itself when the volatility or trend of the market has shifted from a consolidation phase to a trending market. Conclusion. I am long coming into this week, which I am since the VCPMI told us to buy last week at B1 and B2, closing at 1304, activates the average price next week of 1297. And I can start taking profits at 1313 to 1323. When you do take your profits or the market accomplishes this target, you go back to neutral. You can then wait for the market to set up the next fractals, and the VCPMI gives you the new trigger points. This is what we teach our subscribers in our live trading room at the Equity Management Academy. If you would like to receive a trial for you to come and see what we do, just reach out to me. Send me an email, support@ema2trade.com, or give me a call directly at 805 area code 418-1744. I'll have some of those numbers here at the end of this report. As we come into next week, the VCPMI algorithm tells you clearly, based on the third filter, to look to take profits on shorts if the market comes down below 1297, and if you short into that 1288 to 1272 area. It prepares you for those potential unexpected developments that could occur. And if you go long from there, use the 1272 as your stop entry point, and protective level. It is identifying the highest probability to buy coming into next week. The market is coming into next week bullish, trading above 1297, which is the mean. So I am prepared to take profits at 1313 to 1323 next week. This is how systematic the structure identified by the VCPMI automated algorithm can be applied for self-directed individuals. The information in the market commentaries was obtained from sources believed to be reliable, but we do not guarantee its accuracy. Neither the information nor any opinion expressed herein constitutes a solicitation or of the purchase or sale of any futures or option contracts. It is for educational purposes only.